Hey everyone, Weston Nakamura from Real Vision in Tokyo. It is Monday, June 20th, 2022. So as we all know, there's been a lot of volatility in markets writ large, particularly in crypto. And I see a ton of commentary out there on market price action. Where's the bottom? If there's a bottom, on-chain analysis, all that stuff, right? And meanwhile, all of this commentary is like completely overlooking what I see as the clear driver, if not one of the clear drivers, of spot BTC since October 2021, when Bitcoin hit its all-time high of $69,000 and then subsequently fell and is still falling. And that driver is listed derivatives, i.e. futures, and the ETF market. I'm going to lay out what happened big picture with Bitcoin from October 2021 highs until now through the lens of listed derivatives, futures, options, ETFs. No, these are not the sole drivers. There are no such things as one single driver of any asset, let alone the asset class with the most globally diverse investor base maybe ever. It's critical to know how we actually got to where we are, and to see things from a different market perspective than what we're constantly hearing repetitively over and over again. So I'm going to look at Bitcoin through the lens of futures and ETFs. BITO, that is the ProShares Bitcoin ETF, the futures-backed ETF. All of the ones that listed in the United States are futures-backed, but this was the first one to launch in the United States. It launched on October 19th, and it took in about $500 million on the first day. The next day, on October 20th, it took in another $500 million, and it was the fastest ETF to launch to hit $1 billion in AUM in history, and good for them. And then, if you look at this, the inflows into BITO kind of meandered around, just into like the few single-digit millions per day, not much. But then on November 10th, we saw a sudden and massive $1.5 billion single-day inflow into BITO, which is basically 3x the size of launch day. November 10th also marked the very top tick in BITO and indeed in BTC spot at $69,000. Okay, now I also want to take a look at CFTC Commitment of Traders report, which is basically a weekly, reporting that you have to do as if you are a futures trader and you have a very large size position, either long or short. And if you do have such a position at a certain threshold, you have to report it to the CFTC, and then they publish it weekly, and they put you into one of these categories: asset manager, dealer, leverage fund, other category, whatever it is, right? And you can see like what the net positioning is week to week. Now, if you look at this, you'll see that asset managers suddenly opened up net long BTC positions, also about $1.5 billion notional in size, okay? Which, again, matches the BITO inflow size. Okay, so just keep those two in mind. Now, those are very much interrelated, but let's just pick them apart one by one. So your first thought when you look at either the $1.5 billion inflow into BITO ETF or the $1.5 billion notional net long futures opened up by asset managers, right at all-time highs for both of them, to be a horrendously shitty trade or horrendously shitty timing, right? Like they went, there was $1.5 billion of inflow right before all-time highs. And furthermore, on the futures positioning side, it seems that asset managers have just held their longs throughout till this day, right? If not increased them, as BTC has now dropped 70% since then. And then that might be troubling to see that, even after a one-way 70% decline, the asset management community has yet to even liquidate their holdings. And that's like overhanging this sell-off, like capitulation, all that's yet to come because there's still this like long position. Now, let me explain how this world of ETFs and listed derivatives works. And you'll see that in reality, the mechanics paints quite a different picture, okay? This is going to be the most oversimplified 101 explanation of how ETF creation and redemption, how that process works. Creation and redemption. If you want to find out more about, how that works, there's plenty of resources out there to do so, and by all means do so. But basically, when there's inflows of capital coming into an ETF, okay, then new ETF shares are created by the ETF provider who works with the institutions that are designated to create these new shares. And the way in which they're created is that these institutions go out and they acquire whatever the underlying asset or the basket of assets is that comprises this ETF in proportion to how many new ETF units need to be created. Okay, so let's say when there's a ton of like new inflow of capital coming into XLE, the energy sector ETF. Okay, the ETF providers, they take this new cash infusion in exchange for new shares of newly created XLE shares. Those new shares of XLE are created by the institutions called authorized participants who go out into the market and they buy up like all the components that make up the XLE index or basket, such as ExxonMobil and Chevron and various other shares in proportion of weighting. And they do that in order to deliver new shares of XLE backed by this basket of energy stocks. And then ETF redemptions are the same process, but just in reverse. So ETF shares are effectively dismantled, if you will. The individual components of the ETF are sold, and the cash proceeds are returned to the ETF redeeming investor. So when BITO, the BTC futures-backed ETF, sees a ton of capital inflow flooding in, as per November 10th that I mentioned, new shares of BITO need to be created. And that means BTC futures contracts on CME need to be acquired. And that's what we saw in the October run-up to new highs, to new all-time highs in spot BTC. Okay, we saw spot BTC upside that was led by futures. And these newly launched Bitcoin futures-backed ETFs, which began to acquire futures in order to have these ETF shares available for launch. Okay, this is a key point that I want to repeat. In October 2021, there was a 40 or 45% sudden rally, like from the beginning of October to its all-time highs later that month. This was a futures-led 40-50% rally in Bitcoin in the span of about 20 days due to these Bitcoin futures-backed ETFs acquiring Bitcoin futures in order to launch their ETFs, which contain Bitcoin futures. In other words, what we saw in October, that 50% rally in 20 days, that was an artificial rally, if you want to think of it that way, okay? This was not new capital rushing into BTC spot, right? Despite like any and every up move in BTC spot being celebrated as such. Like, this is the problem I have with something like on-chain metrics analysts, right? On-chain metrics are great, right? But the analysts themselves, I mean, they can attribute any up move to some sort of like, here comes the real money metric, whatever. And they also never ever consider looking at like non-crypto cross-asset markets, okay? So the October rally to new highs, that was not real. That was not like a real rally. Meaning, prior to this rally, spot BTC was sitting at 40K, and that is where you should really think of as, quote, fair value, if one could determine such a thing. But not like measuring off of that artificial pop and like we're 70% down from there. Who gives a fuck from like 69,000? That was ETFs setting up their business and like a bunch of other flows that are running alongside or front running them. That's all that was. That's why it didn't last, which means that when all of us are measuring Bitcoin is down 70% off its like artificial highs, or saying like Bitcoin starts 2022 off in bear market territory, down 20% off its like November highs. That November 2021 like 69,000 level is absolutely not where we should be measuring from. Like, who knows what fair value of Bitcoin ever is? Maybe we'll never know, right? But it certainly wasn't fair value at near 70K on an ETF creation pump. That was just, the making of a product that did that. So forget 70,000 or 69,000 November 2021 as the highs, and forget measuring from that point. So let's just say BTC at 40K, the level that it was before taking off in October to all-time highs and then just falling right back down to it. Let's just say 40K as fair value. Now, with this nonsense 69,000 price out of sight and mind and resetting at 40K as a base price, now take a look at Bitcoin performance. We're hovering flat at 40K, right? Right in line with NASDAQ, percent for percent. NASDAQ was flat for the end of calendar year 2021. If you just eliminate that ETF creation bump up and subsequent crash, right? Basically, if not for that, Bitcoin would have just been flat along with NASDAQ, which means that Bitcoin hit bear market territory around the same time NASDAQ did in Q1 of this year, not in November of 2021. So indeed, Bitcoin has been tracking the NASDAQ this entire time. It's not like a new phenomenon, really, if you ignore that price bump and stop measuring from that artificial high. And then, furthermore, you can see the actual Bitcoin and crypto specific divergence in May with Terra Luna and all that. That's when you start to see the actual crypto specific sell-off. But otherwise, it's just, keeping beta with NASDAQ. Now, back to ETF flows and share creations and redemptions. As I mentioned before, seems like there was a $1.5 billion single day inflow into BITO and a similar $1.5 billion notional BTC futures net long position opened by asset managers just right before market top, with the ETF flow dwarfing any other day since inception in both inflow and outflow, and the asset managers futures net long still open and still holding firm despite this price collapse. What's up with all that, right? So, I don't know for sure. Here's my best guess. This was not an ill-timed major long position at all-time highs, now down minus 70%. It's quite the opposite. This was a short position, and not a well-timed short, not just a well-timed short, but rather a market-pressing, downside-triggering short position. Okay? So, let me explain. When you short a stock, you borrow shares from someone who is long, who is willing to lend you their shares for, short period of time in exchange for some borrow fee or rate or whatever, right? And so you borrow shares from somebody and then you sell the stock and then, your position is open and then hopefully the stock falls and then you buy it lower, thereby covering your positions. So you have to buy to close the position and then you return the shares to its rightful owner and you keep the difference in between. That's how shorting works. Now, when you short an ETF, you can do the same and borrow existing ETF shares to sell short, or new ETF shares can be created for the purpose of selling short. This is otherwise known as CTL, or create to lend. Okay. Now, unless you're a prime broker or in securities lending, it's pretty much impossible to know for sure if an ETF's inflows and subsequent shares created are being used for actual long positions or if they're being created to lend and to be sold short. Take KWEB, for example. This is the China Tech ETF that saw a 70% decline in 2021 as Chinese tech stocks got slammed despite about 7 billion in inflows over the same period. So sure, this can be interpreted as, quote, retail flows are relentlessly coming into Chinese tech shares in a failed effort to buy the dip despite no bottom, found or whatever. Or these are not buy inflows. These are shares of KWEB that are being created in order to short KWEB. And you can see the volume profile and all that. And it certainly seems that is the case. Now, this create to lend thing, this also works in reverse. Okay, in other words, so when you see outflows from an ETF that had shares created in order to short, they're essentially position closing and short covering. That November 10th 1.54 billion single day inflow into BITO. I believe that was shares that were created in order to short the hell out of Bitcoin, and it did so successfully. And it didn't do so timing it perfectly. It was the actual, trigger catalyst. Bitcoin, or be it any asset, I'm not saying that these short positions are driving the entire flow, the entire direction downwards, but something like Bitcoin, people buy because they buy and they sell because they sell. And so all you need is just to get something kickstarted in motion, and that triggers, selling begets selling. It triggers margin calls. It triggers stop losses. It triggers a whole bunch of things, and algos and so on and so forth, and momentum trading. So, it doesn't need to do the entire drive down, right? How would you make a profit off of that anyway, right? It just needs to get the kind of avalanche going. It needs to be like the initial snowball off the top of the hill and then turns into an avalanche, okay? So that is the significance of the ETF share creation and redemption as it relates to BITO, as it relates to Bitcoin spot. Now, this create to lend process of ETFs, that also works in reverse, in which outflows from an ETF that were for shares that were created in order to short are essentially, redeemed. And that's basically closing a position and short covering. Okay? So we have an example of this from February 24th of this year with a $40 million outflow from BITO, which coincided with a 5-day 30% rally in spot, or a position closing by short covering futures and redeeming of BITO shares. If you look actually at May 2nd, you'll see $70 million outflows from BITO that was followed by a 20% fall. So in that case, that was money being pulled out of the ETF and a subsequent fall. There are some advantages, some significant advantages of shorting futures-backed ETFs. First of all, when it comes to futures-backed ETFs, just in general, namely commodity ETFs, in a normal market, okay, not current ridiculous commodity markets, but in a normal, market with a futures curve in contango, okay, where the futures price is higher than the spot price or the front month contracts, in that sort of normal environment, then holding these futures-backed ETFs over the long period, over long periods of time, that ultimately leads to bleeding away all of its value due to the negative roll yield. Every time you roll expiring futures forward, you're paying ever higher costs because you're selling futures that are about to expire, and you're buying futures for the next contract that are far more expensive. And every time that you do that month after month, it eats away at your capital. So what that means is that if you're short these structurally declining ETFs, you get that, that phenomenon working in your favor. So that's another sort of benefit of being short these sort of, I guess you could call it a commodity ETF, but these sort of ETFs that have a futures curve that is in contango. And then you can also sidestep or hide, behind disclosure requirements on large size positions if you work through an ETF. ETFs are also not really subject to something like the uptick rule, okay, which makes it easy to get into the downside and press in rather than wait for it to, have an uptick and then you can, put your position on. And then, of course, with BITO or even with CME futures, you have basically unlimited open interest capabilities. Whereas, yes, there are limitations for these ETF, these futures-backed ETFs and how many contracts they can hold. I think it's 4,000 is max right now. But still, there can be theoretically however many ETF provider, ETF providers out there, futures-backed ETF providers out there, and there could be an infinite number of like no limit to how many futures contracts can be opened on CME, right? As opposed to Bitcoin spot, in which there's obviously a fixed quantity. So BITO, which by the way is not the only futures-backed ETF, although it is the biggest because it was the first, out of the gate. As per my clip of this video that I put out when these futures-backed BTC ETFs launched, we have the debut of the Valkyrie Bitcoin Strategy ETF, ticker BTF. It used to be originally the ticker BTFD, and for those who have been living under a rock, BTFD stands for buy the fucking dip, which is a cool way of saying buy low, sell high. Maybe not the sell high part, but buy low, which is a cool way of saying value investing, I suppose. But yeah, BTFD, buy the fucking dip. That's what they tried to register as with the SEC, but then given the provocative name and the fact that that name was causing like extra time to review and approve by regulators, and this is a race amongst issuers, because to grab AUM, cannot waste time on some review and approval process. They ended up dropping the ticker BTFD and instead went with BTF, or buy the fucking. I'm not like a linguist expert, but I think they dropped the wrong letter. And BTD, by the way, I looked it up, like BTD, buy the dip, which would be far more appropriate than buy the fucking. Also makes grammatically more sense. BTD isn't taken either. BITO is the big dog of the futures-backed BTC ETFs in the United States. BITO holds the front 2-month futures contracts of CME Bitcoin futures, okay? It doesn't hold any micro Bitcoin futures contracts or anything like that. And it posts its holdings on a daily basis. So if you look at this latest, as of June 20th, BITO holds 3,485 June Bitcoin contracts and 2,832 July Bitcoin contracts, for a total of about $600 million of notional exposure to Bitcoin to Bitcoin futures. Now, let's take a look at CME's latest data on Bitcoin futures. There are currently about 8,500 June contracts of open interest and 3,700 in July open interest, which means BITO currently holds about 41% of all June CME Bitcoin futures open interest and holds 3/4 of all July futures open interest. And also note that upon launch of these futures-backed ETFs, CME overtook Binance to become the world's largest BTC futures exchange. CME futures, as well as other futures exchanges as well, but CME futures will dictate the price direction of underlying spot Bitcoin. And so, if BITO holds about half of the front month and 3/4 of the second month futures contracts on the world's largest Bitcoin futures exchange, then you need to pay attention to BITO and these derivatives if you're concerned with price action of spot BTC. You need to not just be aware of them, but to try to understand how inflows and outflows are affecting price direction. Don't be that guy blindly thinking all inflows means buying and all outflows means selling. Obviously they can be, but obviously they can be the exact opposite as I just mentioned. And look, this isn't just theory. As I just walked you through, the October sudden rally to new all-time highs, the blow off top, the subsequent fall driven by the shorts who are making far more of a killing shorting BITO or CME BTC than they would be shorting the NASDAQ because of that 40% extra bump higher that BTC got, from which, a higher point to short from. Okay? So, I just explained how Bitcoin got, to that all-time high in October. That was an artificial, product entrance into the market that did that. So, do not measure off of that level. I would suggest using 40K. where it was flat with NASDAQ the whole time, right? So if you look at it from that angle, it could be either good or bad, however you want to interpret it, right? It could be good because, oh, so Bitcoin actually didn't fall as much as it did. And it could also be seen as, well, Bitcoin therefore still has a lot more to fall. It's not down 70%, it's only down 50% or whatever it is, right? However you want to interpret it, it's up to you. I don't really care. But don't look at it from that artificial top. With Bitcoin, you're pulling forward so much of the future that of course it's going to trade like a risk asset alongside like the NASDAQ stocks that don't have cash flow. Of course it's going to. There's nothing wrong with that. That's fine. That's how it should be, right? But that, like, in this current environment. So if that's the case, what are those like no cash flow, high valuation stocks being affected by? What are they moving to, or what are they being moved by? They're being moved by and large, interest rates. What are rates being driven by? Rates are being driven by the market's perception and pricing of monetary policy, as well as things like market sentiment on FOMO, fear of FOMO, knee-jerk algo reactions to headlines, geopolitical risk, market deleveraging by choice, forced deleveraging by prime brokers, by risk managers, by brokers, stops and limit orders, margin calls, options, dealer gamma hedging activity, technicals, thinning liquidity, pockets of sudden illiquidity, passive vehicles, correlating like listed securities and pushing things way out of fundamentals, systematic flows, cross-asset correlations within systematic flows, active funds, managing for career risk and not for market risk, momentum and trend following flows, need for cash, need for dollars, need for yield, M&A, speculation of M&A, fear, greed, panic, buy the dips, sell the rip, all that stuff, right? These are like the crypto is not exempt from any of that. And the more institutionalized it becomes, the more it becomes part of these structures within, such as the listed derivatives and the ETF structure. Okay, so I hope this was helpful. I hope it gives you a new perspective on how to look at crypto. And as painful as it might be, as long as you're not using leverage, let's welcome the volatility, because volatility at the end of the day means free markets, which is something that we are deprived of. We, especially my generation, has been deprived of all of our lives. And this is the first taste of actual capitalism that we have. And so let's not forget how precious that is. And let's try to remember that during the rougher times. Follow me on Twitter at Across the Spread, and make sure you're subscribed to both Real Vision Finance as well as Real Vision Crypto. And we will see you soon. And thanks a lot for watching.